Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at McNichol & Associates Asset Management. Welcome, everyone. This is our monthly video that will give you an update on our thoughts on the markets. And today we've got Joe Poshadiniak talking on alternatives and a project in Jacksonville, Florida. Then Ken Reid will talk about the public markets, equities, gold, currencies, and then I'll finish up with another bit on AI. I just want everybody to pay attention to this disclaimer. We are not offering financial advice here. If you want financial advice, you got to come to us directly so we can pair it with exactly who you are. And over to you, Joe.
Okay, great. Thanks very much, David. And just taking a look at our retail asset here in Jacksonville, Florida. This is 8102 Blandling Boulevard, also known as Crossroads Square. Just giving you a shot from the drone. The next slide over is really a summary of the performance of the asset to the latest reporting period. So, doing just fine, 97% occupied. There are two vacant boxes totaling just under 6,000 square feet. So a couple of small plots that can be leased up. And just some background on the asset. Acquired this in 2014, and that base rent figure, which I've put the red box around, 45% higher than at the time of acquisition. So definitely in line with forecast. In fact, just looking at the annualized number, 1,675,000, slightly ahead of target. So in a world where everything's digital, Salesforce, those sorts of companies, it's good to see the old bricks and mortar locations are still getting traffic, and tenants that are for the most part paying. These are the tenants, and you can see the sizing and the lease expiration and all that kind of stuff. The ones in green and yellow highlight were the changes in the leasing activity. So starting with lease renewals. We did renew the anchor tenant, which is really important. That's Floors and Decor. That is a large, I believe, 26,000 square foot asset within the building, and that's going to kick out just under 86,000 in additional rental income. So, really pleased to hear that. Also, around the clock, childcare was also renewed for a 5-year term. That one's got 5% bumps annually and should finish off at $17.5 per square foot in 2030. We'll just take a look at the lease expirations or the new leasing activity. Great. And so we did pick up a new leasing activity. We did pick up the Honeybee Bakery at 17 per square foot with a 3% slider. That's a triple net lease. And also, the one sort of issue there on the new leasing activity was Lighting Shared Scooter Company, which is an e-scooter rental type of outfit. Signed on the dotted line, but actually backed out 2 months later. We did grab 25,000 off of them in advance payments and early termination fees. So just some good property management. There was one termination. Just to summarize, there was an ATM machine, actually the smallest tenant by footprint, one of those drive-through ATM machines with JP Morgan. It's only about 21,000 in annual rent. They have moved on to other opportunities. So I'll pass it back to Ken and David.
As Dave said at this front end, I'll just quickly try to go through these public markets, explain what's happened over the last month. Obviously, a bit of a more rocky month than we've seen, we'll say, over the last year, but kind of flat basically now. We had a bit of a dip in mid-November, but back to close to 6,900 for the S&P. A bit of divergence in the tech names that we'll mention later, but really a nice rebound here to end the year in terms of demand and technical support. So the U.S. market does look poised for some upward movement from here, but the TSX looks even stronger, we think, from a valuation standpoint, trading at about 20 times forward earnings. But on the technical side, the overbought, oversold never dipped very low, has these strong support lines, has just broke out to all-time highs past this zone that it's been trading in for 2 months. Some strong earnings from some of our largest companies here in Canada, from the banks. Obviously, the resource stocks have performed very well in Canada as well this year. So we're very bullish on the outlook for Canadian equities, and we think there will be continued inflows to some of the more attractive names. Now, quickly flipping over to currencies, the US dollar in the short term has reversed its trend since mid-September. It is one box away here from creating a buy signal, but it is well off the pre-Trump levels. He did say he was going to devalue the US dollar, and he's done basically that. He hasn't done it through massive inflation prints. Obviously, we believe inflation is running a little hotter than reported, but nonetheless, the US dollar continues to move lower relative to most major currencies other than our Canadian dollar. So currency movements really haven't impacted our returns or exchange rates on our in most of our accounts, which are denominated in Canadian, but we hold some US securities as well. Looking here at gold, this is just obviously our alternative to the safe haven that is US dollar, US treasuries. It's been consolidating for a few months here. This is GLD, the ETF, one of the largest ETFs that holds physical gold. It's broke out of these channels 3 times over the last year and a half. We think this consolidation is something that was due, just because gold hasn't gone straight up over the last month and a half, 2 months, 3 months. Doesn't mean the trade is over. We think there's still some more upside on the technical side. But then when you look at the miners with gold trading at this level, they're producing some of the strongest free cash flows that we've ever seen. And we think that it's going to be a strong boost to earnings as we hit into 2026. Now, on the macro level, the yen carry trade continues to blow up. Obviously, we've mentioned interest rates moving up in Japan. They've moved up higher recently. Here you can see on this bar chart, obviously, for years, Japanese interest rates were at basically zero to combat deflation. That's changed. The central bank has the support of the new government to continue to increase interest rates, which has pushed up yields in Japan. It's pushed up yields globally, including in the US. And then some risk assets have also taken a bit of a move lower just because of the borrowing that was going on to fuel liquidity in financial markets, both debt and equity. So we potentially could see some dried up equity, specifically in North American markets, where some investors were tapping Japan for debt to move into other assets. And then just looking at the tech, I mentioned we were going to be talking quickly on AI. David has a few slides at the end, but I wanted to mention a few things first. This is part of the AI bubble. This is the credit default swaps for Oracle, which are at a 16-year high dating back to the end of the financial crisis. That is because they are leveraging themselves up without significant cash flows coming from AI to build out their cloud computing platform that is going to fuel OpenAI and other customers who are building out their language models utilizing artificial intelligence. Looking here, this is the annualized cumulative CapEx for the hyperscalers. So the 5 hyperscalers, Amazon, Microsoft, Google, Oracle, which I mentioned, and Meta. Oracle and Meta are the 2 to watch just because their cash flows are very thin compared to the other 3 giants who can utilize some of their cash flows from their other points of their business to fund these adventures. But you can see basically in the last 3 years, the CapEx has basically tripled from these 5 companies. and it's expected to continue moving forward. And then the final slide that I want to mention, this is just a chart that tracks borrowing to fund AI data centers. You can see the jump in 2025 where it jumps all the way to about 120 to 125 billion, most of which is Oracle and Meta in this, represented by this orange and light blue line. They're tapping debt markets. Their Oracle is tapping loans, and more of these companies are going to alternative source of funding. Meta had that large deal with Blue Owl, which was one of the largest private credit deals ever. We expect this to continue, but is it sustainable is our question. And with all that, I'll pass it over to David.
Yeah, I want to continue along Ken's line of reasoning here, and really this might be repetitious, but as they say, repetition creates penetration in our brain, because we want this to really just sink in. AI is real. We believe in it. We use it every day in a lot of our processes, and we've just actually found another one that consolidates all of the ChatGPTs, Groks, Perplexity, and two others, and allows them to solve a question or a problem. But then they all have biases built into them. And so out of the top, we're going to be getting, we think, more exacting answers to the questions that we all have. But we worry that AI might be just getting ahead of itself now. Basically, it's like anything. The internet is finite. It is not infinite. So they've all scoured the internet and got everything that they can out of it. And really, what can happen next now? The robots, etc. There's always another level, but we think that there could be a sort of a flattening, cooling off period. So this is from Michael Kuba, who wrote, OpenAI has been in the center of a lot of the recent AI hype, but as HSBC points out, OpenAI's total deal value, announced deals, sits at $1.8 trillion. That's with a capital T. This creates data center rental bills of $620 billion per year. This leaves a funding hole of $207 billion per HSBC estimates. If OpenAI stumbles, what happens to the AI hype cycle? And then they're all getting all levered up. Ken's already gone through this, but AI CapEx is going far beyond cash flows. Companies are levering up in a major bet it will eventually pay off. When will investors start to demand tangible ROI for all of this spend? And that's the real question. It's when. And maybe they think that they're going to grow into this new scaled up system, but we're skeptical. So we'd rather stick with our private technology investments with Georgian partners, who found one of the most successful ones in Shopify, and they've got some other ones that are brewing that I'm sure Joe will update us at some point in the future. And we are just about to announce we've got an investment in the private investments of Starlink and SpaceX. And you'll be hearing more about that as well. So we'd rather own these as private enterprises that don't have the crazy, 50 times sales type of valuations that many of these AI ones that are in the public markets right now. Okay, that's it. Thanks for listening to us. And as always, if you have any questions, just reach out and we're here to answer them. Bye for now. Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks and visit mcnichollasset.com to learn more. Bye, bye, bye.